Good evening, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, the S&P and the Qs sadly down. But you know what wasn't? The equal weighted SPY. Today was another example of the market breadth that we've been describing over the course of the past month. You might remember, if you've been a recurring viewer on the channel, we were comparing and contrasting two different all-time highs. The one that we had back in October, in which we saw very high concentration in the market into big tech and into AI, and nothing else was really participating. You might have been able to notice that when we also described it on the channel, all the way back here, where your percentage of stocks above their 20-day EMAs were all the way down here, late October, very weak market breadth. Percentage of stocks above their 50-day EMA, which is the institutional monitored average, well, they were all the way down here, very low in terms of only 40% of all stocks above their 50-day, and even the longer duration moving average, such as the percentage of stocks above their 200-day moving average, well, that was all the way down here and did move a little bit lower into the early stages of November. Now, all of that has since changed. We now have a new all-time high and arguably a more healthy all-time high as more and more sectors start participating in the markets. However, during this broadening out of the market, we have had certain key themes and names that just haven't played along as much as they had last year, namely big tech. Now, big tech, there's a few bullish points today, such as the nice rallies on Amazon, Google, and a little bit of Tesla. But for the most part, a lot of the same big semiconductor names that were working really well for a large majority of last year just haven't been doing anything. Looking at you guys, NVIDIA, Broadcom, and AMD, and even some of your other big tech names have been somewhat lackluster over the course of the past 2 months. Now, that may disappoint some of you that are very heavy into these names because we haven't really seen much gains if we are heavily invested in these names, especially over the course of the past 2 months. However, this broadening out of the market is a very healthy rotation, arguably a much better all-time high currently than we had previously at the late stages of October. So we're going to talk more and more about this rotation, but once again, in Monday's video, we did the key themes and trade ideas for 2026, and it all had to do with the broadening out of the market. I spent like 30-40 minutes describing the key themes and potential ideas coming into 2026. And although we're very early into the start of the year, so far those themes and trades have been playing out per our descriptions that we just derived in the Monday video. So definitely go check that one out if you hadn't done so far. Now, in today's video, we'll be doing a few different things together. Number one, we'll be going over some key news elements that came out today. We had more jobs data, but also I'll bring you guys some interesting statistics and some interesting charts to kind of see what's going on behind the scenes in the markets today. Now, moving forward after that, we'll take a look at our technical analysis, run through the SPY, the Qs, and most of your major sectors, check on the infamous broadening out of the market and the sector rotation. And lastly, we will go over our big tech list and kind of do the same because we know a lot of these big tech names are still somewhat flat in the past 2-3 months. So of these big tech names, which are in nice locations to possibly start some positions for long-term portfolios or add to them, and which could also be some very good swing trades into the rest of 2026. And last but not least, of course, we will cover our biggest gainers and losers of the day, of which there were many, and we will once again play our new game of, is it too late to invest in some of these companies that have printed highs since the beginning of the year? And additionally, take a look at some names to the downside, because today there were a lot of them, and a lot of them were data center specific. So are these names still good to invest in? Is the hype gone? Should we even be looking at them in the first place? We'll kind of talk about a lot of these names at the end of the video as well. So that being said, that's going to be it for today. So let's move right into it, shall we? The S&P down 0.01, the Qs down 0.57, but take a look at the heat map as we just described, guys. Very healthy rotation. However, you will notice that all the names that were big red today, they all had one thing in common. It's all of the names that were really profitable last year, especially during April through October when we had the big data center AI build-out phase. Looking at the Oracles of the world, even Palantir, a very popular retail name last year, hasn't really done much of anything in the past 3 months. It's just kind of stuck in this very long duration range, right? So names of last year probably not going to be the best performers of this year. Now, that's not to say that they're not going to do well this year in terms of just total ROI. However, we might be able to look beyond some of these names that we've played in the past and still be able to get some pretty decent ROI. So that being said, look at all this. Most of the semiconductors that were very popular last year are down today. Keeping that in mind, a lot of your semiconductor equipment companies that started off the year with a bang, well, they were just having a healthy pullback today. Semiconductor equipment players and even Micron. Micron had a great start to the year, but pulling back. Some of your major healthcare names down, financials largely doing very well. And the bottom half of the market is definitely the big highlight for today. Defensives, industrials for the most part, other than, surprise, surprise, GE and GE Vernova. Big winners of last year. Some of the engineering plays associated with the data centers, Fixed Comfort Systems, PWR, names that we don't talk about too much, but that did have a beautiful 2025. And here you go. Utilities, very strong day, except of course for, well, some of your independent power producers, such as Constellation, VST, and NRG, some of the biggest winners last year in terms of the data center expansion trades. So there is some very big money rotation going on. It doesn't mean that these names won't do well for the majority of 2026. Their earnings are very strong and the AI thesis is still clear. But what you're seeing right now is a little bit of early year positioning into the rest of the market. Several of these sectors have done nothing for the past 2-3 years. So maybe it's time for them to win a little bit, right? Moving on to the one-day relative performance, guys, you can see that even better to where most of the market was very green today, except for healthcare and technology, sadly. On the 1 week relative, you can see the further broadening out of the market. Very healthy chart right there. But look at the bottom, utilities and once again, technology. Big tech not doing too much of anything, and your large semiconductor players also not doing too much of anything either. So before we get into more technical analysis and more sector-specific rotation analysis, let's go over some pieces of news that came out today. Well, of course, number one, we got to talk about the Challenger jobs report that came out very early this morning. And despite still showing a slight loss, was a far cry from the massively negative number that we got in the month of October that sent the indexes down 2% that day. November was minus 71,000 and now December 35,000. So still a negative number in terms of 35,000 job cuts in December, but not as steep as we saw in the past few months, which is why the market didn't really react much to the downside. Now, keep in mind, though, guys, tomorrow we have an even bigger jobs report, and it is going to be the non-farm payrolls with the infamous unemployment rate. So keep that in mind. The expectations are for 4.5. I'll remind you, last report was 4.6, so that would be a step in the right direction. Non-farm payrolls, you don't want to see it come in too hot or too cold on either side. If this one comes in way too hot, well, you can kiss the odds of a rate cut goodbye, at least in the next 2 Fed meetings. And if it comes in way lower than expected, well, you would expect the markets to get rocked to the downside and volatility to probably spike. So this one needs to come in kind of either slightly higher or slightly lower if you want to see a normal market reaction to these numbers and continue this market breadth expansion and possibly the march towards more all-time highs. Now, in terms of other things that happened today, well, we had Treasury Secretary Scott Bessent saying more Fed rate cuts are the only ingredient missing for the stronger economy. Now, one of the reasons he said that, of course, was because of this massive GDP estimate for Q4, guys. The Atlanta Fed revising the GDP Now estimate, guys, to about 5.4% for Q4, which is absolutely massive in terms of economic growth. Now, I know some people will push back that this is mostly because of infrastructure and AI buildouts, and this very well might be true, but those are real jobs, and that is real money being deployed into the US economy. So very nice GDP projection. As I was saying, for a better part of this year, guys, it's very hard to derive a massively bullish thesis or to even think of a recession when you have so many big bullish macro tailwinds, such as strong GDP, as we literally just saw, rate cuts at the end of quantitative tightening with a bit of a QE boost, $40 billion a month, still low in unemployment, but we'll monitor the situation tomorrow. Lowish inflation, as we've been commenting on this, guys, inflation and that narrative is largely beyond us at this point. Inflation rate now stands at about 1.91%. You also have very strong earnings. I keep bringing this up almost every single video, guys, but the earnings this year are going to be substantial. We'll take a look at the charts in just a few moments. And of course, the continuation of the AI megatrend, which leads to efficiency and productivity increases. I got a chart for that as well today. And lastly, well, you got the $4 trillion in tax cuts, right? So a lot of Fed policy stimulus and also a lot of fiscal policy stimulus. Very tough to be bearish on the markets when you have all of these things going for you at the same time, but we will monitor the job situation very closely moving forward. Now, moving a little bit further here, the October trade deficit, this is all about tariffs, and tomorrow's going to be a big day for tariffs. Supreme Court may give a ruling tomorrow, 10 a.m. Eastern, as to the legality of the tariffs and if they are supposed to be reversed or maintain. That's going to be a very big day. But for now, the October trade deficit narrowed to $29.4 billion. Very, very strong. That is the lowest trade deficit for the United States since 2009. And a big component of this GDP boost as well, guys, is the boost in exports and the reduction in imports. If you know how GDP is calculated, that makes perfect sense to you, right? Take a look at this. Goods and services balances, guys, the lowest since 2009. So the tariffs still bringing in an incredible amount of money overall. I thought that this was a very interesting statistic for today. Moving on a bit further here, the market breadth is also expanding. We just showed that on the SPY, the QQQ, and the sector rotation. But take a look at this, guys. Percentage of stocks at 52 weeks highs right now. We're almost at 12% of all stocks. Usually when that happens, it's synonymous with the market broadening out. This has not happened, guys, in about a year's worth of time. And usually your performance thereafter is quite good as measured on a 1, 2, 3 week basis, 1 month, and even at a longer duration than that. Your average is positive all across the board when you see events like this where the market broadens out to such a degree. Moving on a little bit further here, as we keep saying, or we've been saying for the past 2-3 weeks at this point, the expansion of the markets are not so much driven by multiple expansion. They are driven by real earnings and real profits. The pre-tax corporate profits right now are sitting at some of their highest levels that we've seen since the 1960s. Very, very, very strong, guys. The past few years have seen an expansion of corporate profits. And as we've said, the guidance is that is expected to continue. S&P 500 earnings are supposed to grow at about 15% this year, which is a lot higher than the last 10-year average of about 8.6%. That data is from FactSet. I'll just show you guys if you guys haven't seen the video so far. It's right here. You can dive into FactSet's report, but 15% far greater than the last 10 years of 8.6%. So real money is being made by these companies. Moving on further here. Once again, the contrast between sales growth and margin growth versus multiple growth. As you can see, the gold column here is what you got to pay attention to, right? These are your S&P 500 returns for the past 3 years, very bullish years. But how are those returns made? If they're only made by multiple growth, then you can say you're in a bubble. If they're actually driven by corporate sales and corporate profits and margin expansion, well, then you can't really say that a lot of the market is in a bubble. As a matter of fact, there may be certain names here and there who have stretched valuations, but by large and by far, a lot of other segments of the S&P do not have those same characteristics. Here's your chart of the day, of course, as well. This is from Bloomberg and Goldman Sachs. Here's your cumulative growth in terms of investment grade and high yield debt. So once again, about a month ago or so, we kept talking about the debt loads of Oracle and CoreWeave and some data center specific players. But is it broad-based? Is there a problem in terms of solvency for a lot of major corporations out there? Well, the late 2000s, the last quote-unquote bubble, that is when you saw an expansion of debt, large expansions in debt. The expansion of this current AI boom is not driven by debt at all. Look at the difference in percentages here in terms of cumulative growth of either high-yield debt or investment-grade debt as well. Very low numbers. I thought this was very interesting too. Moving on a little bit further, for all you gold guys, all the gold guys out there, the dollar's role in the global reserves is withering away. The dollar is now under 50% of total reserves in terms of global government reserves. And gold now moving a little bit higher. Very interesting chart here as well. The flippening happened early 2025, and it's been getting a bit magnified ever since. But the other currencies are not immune to this either. You can see that euros, yen, and even pounds are dropping, all in favor of gold too. And last but not least here, guys, I will remind you that this is something that we've been seeing over the past few months. Hopefully now you guys can see it, especially on a day like today, where the Mag 7 and large cap tech is still nowhere to be found. No clear trends, still oscillating around relative lows, rather relative monthly lows and things of that nature. This is not new. This all started a couple months ago and has been accelerating recently, guys, in terms of, that's not the chart. Here it is, right? This is your essentially fund flow. This ETF is called XMAG. It is basically the entire market, the entire S&P, the 493, without your Mag 7. Look at the difference in inflows. People largely at the midpoint of last year, when the AI trade was super hot and the market was very concentrated, everybody was in Mag 7, and basically all the names that are red today. You don't got to look any further than that, right? Other than healthcare, of course, right? But you guys get what I mean in terms of tech-specific names. Now, you got a whole bunch more fund flows into ETFs like this, XMAG7. Look at this December inflow right here. Absolutely massive. And from what we can see into early January, that is now continuing as you've had quite a few days like this since the beginning of the year overall. So keep all of that in mind when you're looking at the analysis and you're trying to derive the macro and trying to derive some insights into the rotations that are underway in the market right now. I do stand firm in saying that yes, big tech will probably still have a very decent year. A lot of the AI favorite names from last year will probably indeed come back. But in contrast to last year, you may not have to only be in those names to make some money or outsize returns this year. You can actually broaden out your horizon. There is definitely going to be something for everybody in this year's market, in my humble opinion. So keep that in mind. And if you want to have more insights into how you could play possibly certain sectors, Monday's video, the title is 2026 Themes and Trades. And I'll be referencing that video quite a bit because it's very cumbersome for me to do that every single video moving forward. So that's it for your early news cycle. Let's get into some charts right now. So in terms of the S&P, guys, well, the S&P flat on the day. And it's so funny that, you know, on days like today where you can have literally seems like 85, 90% of the market pushing forward, but not just pushing forward small, right? Decent gains. Whenever it's bright green like this, they're like over 2% gains. So many companies across many different sectors moving a lot higher today, but just the sheer weight. And we even had Amazon, Tesla, and Google, right? But just the sheer weight of some of the semiconductors, Microsoft, Oracle, Palantir, big names like Eli Lilly, AbbVie, some of these semiconductor equipment players, right? Some of the largest players in their technology respective segments were down. And because they're just worth so much, even with all this green, the S&P was still flat. However, the broadening out is very healthy right now. And as a byproduct of that, right, big tech hasn't done anything for a while. I mean, we'll look over these charts a bit later, but look, I mean, Apple's been coming down for the past month and a half. AMD hasn't done anything for the past 3 months. Amazon is finally starting to break out, but has it really gone anywhere? Not too much. Google holding near its highs, but have we had any big expansion since November? No, that's been about 2 months. Meta hasn't done anything for 3 months. Microsoft hasn't done anything for 3 months. Netflix has only come down. NVIDIA hasn't done anything for like 5-6 months. Tesla has been doing good. However, there's some ups, there's some lows, hasn't done anything. And even Palantir, right? Palantir is a $400 billion company right now. Definitely a fairly large size in the index, right? Hasn't done anything for the past 3-4 months. Essentially, what I'm trying to say is if the rest of the market somehow cools off, big tech does have a lot of runway. So keep that in mind. There's a lot of room for rotations in the market this year, not only from sectors that didn't do much over the past 2-3 years, looking at you guys, consumer staples and consumer retail. So not only can we get some juice out of those guys, but now you do have some runway in big tech. So the strength can come from many locations, which is why I do enjoy these all-time highs. And I do still think that we are looking pretty good into the early parts of January. Now, daily uptrend is very clear right now. If we do consolidate a little bit more, looking for a higher low, anything above 680, higher low, possibly back test some of these EMAs and support 684 down to 678 for the continuation of the uptrend. And even if you lose it here, guys, right? Even if you lose that and go into a bit of consolidation, well, the weekly is still not looking too bad. It's just a tightening range above the EMAs, above support. So no red flags as of just yet. The red flags would only come into place if you lose 671. That would be a loss of the weekly uptrend, something that hasn't happened for a very long time at this point in time. And only then would you possibly have an indication that you're going into bigger monthly consolidation. But as of right now, no red flags, just rotation in a very seemingly healthy market. Moving on to the QQQs right now. Well, the Qs, nothing to say here, right? Obviously, they were down today because of the impact of big tech. However, everything doesn't look too terrible. Yes, we do have equal highs. The higher low is down here, 610. This is your line in the sand. If you flush this without a new high, it is a daily downtrend into support 613 down to 605, but no big red flags. Additionally, still just a tightening range with a lot of room above our weekly higher low, a nice 12 EMA, a nice support area as well. So as of right now, no red flags at all. That only happens if you lose your weekly uptrend, set the weekly downtrend. Only then will you understand that you're going for a bit deeper monthly consolidation. But still, monthly consolidation of what? Well, in the context of a great monthly uptrend, right? So that being said, it's very tough to be bearish on the technicals right now, and it's very tough to also be bearish on the macro right now because we have so many tailwinds, both from the Fed and from fiscal policy and many other things of that nature. Moving on to financials today. Financials still, I mean, it's a green candle, but overall still consolidation right now. Beautiful daily uptrend with a lot of room, anything above 54.34, higher low, looking for further trend continuation. And even if you lose this here, guys, not that big of a deal. Financials would just be looking for a little bit of weekly consolidation. The monthly is the clearest time frame of them all. Beautiful monthly expansion, and this is definitely a sector that has many catalysts to possibly expand over the course of this year. The banks should do pretty well. The credit card companies, if we get a broader consumer recovery, they'll do well with the volumes, and even some larger players in financial data such as SPGI and Moody's, which we've been referencing now for the past month and a half, 2 months. They should be doing well. Why? Well, because they have a $5 trillion debt pipeline in terms of re-ratings that is in effect through about 2028. So they have a lot of possible business into the future. So there's many aspects to this financials trades and even insurance, right? Insurance has just been doing nothing for the past year and a half, let's call it. Beautiful accumulation range. So all these various different segments in financials all have something that can possibly go well for them over the course of this year. So financials should do well overall. If you don't know what to choose and what to pick, maybe you just go with an ETF. Nothing wrong with that. Moving on to XLV, moving on to healthcare. Healthcare down about 0.96, but it had a great start to the year, right? Just looking for a daily higher low. It's a beautiful, massive daily uptrend right now with a new all-time high established just yesterday. So higher lows down here, 153, looking for a new higher low to continue this trend. And even if you lose it, guys, is it that big of a deal? Well, no, healthcare is looking very good right now. You got the expansion of the trading range, new all-time high. If you do get sideways consolidation, not the end of the world. The monthly time frame shows this best, right? Beautiful monthly expansion. So any consolidation, guys, even if it goes into a 1 month phase of consolidation, still probably a nice buying opportunity for the good old breakout retest, cup and handle, whatever you want to call it. Monthly time frame looks great. A lot of these monthly time frames, they look really good, right? And when in doubt, you always got to zoom out. You always got to understand where you are in the context of those monthly timeframes. Into semiconductors today, obviously not a very good day because most of that sector was down, and even names that have been super hot recently, such as Micron or some other memory players like SanDisk, et cetera, well, they were down today. But not only that, also the other big equipment manufacturers that had a ridiculous start to the month of January, they came down a little bit. This one down, ASML, AMAT, LRCX, you guys get the drill, right? Just a bit of broader consolidation in semis, but still a very healthy daily uptrend right now. Higher lows are set 359, looking for a new one for possible further expansion. And if it pulls back even harder, who is in control? Your weekly bulls, of course. You got a lot of room here on the weekly, guys. Anything above 340, which is, by the way, into key support, we'll just be looking for a weekly higher low. So there's a lot of room to continue these trends in SMH, and the semiconductor trade is very broad. Like, let's say, for example, you lose Micron into a bit of weekly consolidation after this extended run. You lose Micron, you lose the SanDisks of the world, you lose the AMATs, you lose LRCX, all right? You lose the equipment manufacturers. Well, who is there with some runway to get the rotation for the money? Well, you got a lot of huge players that haven't done anything, right? I mean, just look at them. NVIDIA has some decent runway here to pick up that slack. AMD has some decent runway here as well. Other names such as Broadcom, super strong, right? There's nothing wrong with these companies at all. Their earnings are fantastic and their growth prospects are fantastic as well. Broadcom too. There's a lot of possible room here after extended consolidation for it to be their turn. So not only can you have sector to sector rotation, you can also have intra-sector rotation between certain elements of a certain sector. And that is largely what I would anticipate in semiconductors for the foreseeable future. So pay attention to both styles of rotations between different sectors, but also rotations within a certain sector, right? Moving into the Russell right now. The Russell, not a bad day at all. 1.09% to the upside, looking pretty good here for continuation of the expansion leg. Beautiful daily engulfing move right now. Any move lower looking for a new higher low, obviously. Anything above 246 looking for that higher low for possible further trend continuation. All time frames looking very bullish here, guys. Weekly uptrend. If they close the week like this, that is your new weekly uptrend after we lost it here by flushing the lows. They're now fighting to get it back, looking great for some expansion. I'm not playing IWM as a whole. There's nothing wrong with playing it. Matter of fact, we said the entries for IWM were back here and on the retest. Maybe you guys are in. If you guys are not in, there's no need to chase this one. It could do quite well, but there's many ways to play. You can either play the small cap ETF as a whole, or you can look for individual names overall between the $1 and $10 billion range. There's many very attractive companies, many of which we do cover on the channel quite regularly, especially at the end of the videos in the biggest gainers and losers section. Moving on a bit further here, usually we cover these on Friday, but I want to cover these today because the moves are quite substantial here. So XLP, consumer staples, a lot of dividend companies, a lot of boring boomer stocks, right? Well, perhaps the boomer stocks may actually have a very nice year because in the last few years, we haven't done anything. Literally nothing, right? So resistance highs, support lows, it's been doing this for the past year and a half. Bottoming out process is underway right now. I do still believe this could be interesting if this is your style, right? This is not for everybody. But if you're looking for a possible broadening out of the market for a sector that hasn't really done anything and you don't want to choose individual names, maybe XLP is your thing, right? It also pays a fairly decent, just under 3% dividend. Into consumer retail right now, XRT moving very well as well. Monthly uptrend. That's the first time that that's happened in a very long time. We are breaking out, still nowhere even close to the highs of 2021. Now, if you guys aren't looking to play individual companies such as either Nike or Lululemon or Chipotle or Kava or any host of consumer retail names that have a lot of recovery to do, let's be honest, from the recent highs. I mean, all the names that I just named, like look at Nike, right? Destroyed still. Look at Lululemon, still destroyed. Look at Chipotle, still destroyed. And there's many others on this list as well, right? But if you don't want to pick and choose which company, right? Well, maybe you just go with an ETF such as XRT and you just look to play the expansion. My favorite consumer retail play is Amazon because Amazon has arms in everything. It's an advertising company. It's a robotics company. It's an e-commerce consumer company. It's a cloud company. It's a data center builder. You know, like Amazon does everything. So Amazon is my favorite consumer retail play that still also has many other branches, but still, right? Just an idea. Moving on to XLU utilities. Utilities struggling a little bit, but it wasn't all utilities. No, it was the ones that had the most exposure to the data center narratives. Names like Vistra, names like Next Era Energy as well haven't been having the best days recently, right? So keep that in mind. XLU probably still a very hot play into 2026. It's been in consolidation right now, but we're just going for a key casual monthly backtest right here, maybe for a little bit more into 2026. I think utilities are still going to be the place to be because there's a lot of data center specific plays that are really required for the power. So this is one that I'm not playing in a broad fashion. I'm playing individual names specific to data centers because it's not only going to be 2026, right? It's going to be 26, 27, 28, and I'm playing the independent power producers. Moving on to XLRE, which is a whole bunch of REITs as well. Real estate could be quite interesting, but more specifically, as we've been saying, the mortgage companies, I'm a very big fan of, and also some of the home builders, right? So not too bad. Home builders as well having a very beautiful day today because of the corporate news we got yesterday out of the Trump administration. Trump wanting to ban certain corporate entities from buying single family homes. So that news was well received, of course, as well from the home builders, right? As you can see, nice little bounce. But we've been talking about this, guys. It's just a monthly breakout retest, right? So although there's some news catalysts that can give you these jumps off the lows, it's been an interesting trade literally for the past 3 months, and we've brought it up many times on the channel. So my favorite way of playing real estate moving forward is indeed some of the mortgage companies for the tailwinds from the rate cuts, and also perhaps maybe some of the home builders. But these are a very long form thesis, right? The housing market just doesn't turn around, boom, in the snap of a finger, right? It's a very long duration thesis. But if we were looking to position, arguably it looks better than it did, you know, a year and a half ago. Let's just say that, right? Moving on to energy lastly. Energy's been kind of all over the place this week, from the Venezuela news to the consolidation and profit taking after the Venezuela news to the re-expansion today. So energy, guys, going to be a hot topic this year, especially natural gas for the data centers and things of that nature, right? So energy has also been one that's been in a 3-year range right now, possibly pending a breakout. There's many ways to play this one. You can play it through an ETF. This one is heavy in oil, of course, XLE, but there are many other clean, renewable ETFs that put more emphasis on either nuclear or things of that nature, right? So I'm a big fan of a few of those, right? Nuclear could be very hot. I mean, we could play this with an ETF such as NUKZ, nukes for obvious reasons because it's nuclear. Anyways, sorry. So this one, we have several different ways of playing energy, right? Those are just a couple of them right now. Into the VIX. Well, the VIX still not doing anything, but tomorrow's the big day for the VIX. Tomorrow is either the VIX's graduation day or relegation day, right? If the non-farm payrolls come in as an absolute disaster for December, well, the VIX is probably going to have a decent day of upside. If nothing happens if nothing bad goes wrong with the non-farm payrolls, well, we're probably going to start moving down, right? This little move higher has been in anticipation of these bad jobs reports, but so far, the jobs reports since yesterday have been somewhat decent, right? ADP wasn't too bad, although a little soft. Jolt Jobs openings was softer than expected, which did cause the markets to come down yesterday. Challenger, we literally just covered, it was still negative in terms of layoffs and whatnot, right? But not as negative as November and October. So we'll see what happens for the non-farm payrolls tomorrow, guys. And that'll be your big either volatility catalyst or non-event. You guys know what to do. If you get a big volatility expansion and lower prices on some of your favorite names, maybe you would use an order type such as a sell put under the market on some of your favorite companies that might be close to consolidation areas in which you would want to do that type of trade. The wheel strategy, pay attention to the top 5 options list that I gave last Sunday and all the bonus plays therein too. Moving on to our metals trades right now. So gold and silver, I mean, there's nothing really to say right here. They're still kind of holding this range. The bulls are looking pretty good in terms of this daily uptrend, right? Just trying to set maybe a little bit of a back test into the daily 12. Nothing going on here. Notable to us on the daily, right? They would have to really lose 4280 for us to be worried about a daily downtrend and a larger weekly retracement. But the bulls are in full control right now. They control the daily, they control the weekly, they control the monthly. Everything is looking quite good for gold. But even on this one, right, you got to trade with this one with a stop loss below key levels, because the last thing you want to do is get unwound to some form of monthly consolidation. And it's coming eventually, right? It always happens, either sideways or with a slight downward bias. There hasn't really been much monthly consolidation in the past 4 or 5 months. So we will see. We're still watching out for it. But as of right now, gold still biased long to the upside. Moving on a little bit further to silver right now. So silver down about now this is the new day, 1.07. This was the Thursday session. It was down about 1.52. Once again, silver's the same concept, right? The lows here, very clear support area at about $70.25. So keep that in mind. That is your line in the sand level. Now, you could argue that the bulls are possibly just going for a little bit of a tightening range here before looking for a new expansion phase. And that might be true, but you said it yourself if that's your analysis, right? This is the line in the sand. If you lose that, it's a daily downtrend. You're into weekly consolidation. And the next logical area that silver has tested many times in the past would be the 12 EMA, which is kind of like mid 60s right now. That could possibly be a decent re-entry location to scout out some trades. But as of right now, the bulls still in control of the daily, still control the weekly as well. Although this week, if it closes like this, not looking the best, but still, and the monthly is still very much extended here on the RSI. So just keep all those things in mind if you're looking at the metals into the near-term future. Now, moving on further, we're going to do a little bit of crypto, and unfortunately crypto as well, suffering the same fate as some of the big tech names. Unfortunately, they seem to be moving right in line with the QQQs at this point in time. Bitcoin still doing a whole lot of nothing, hunting for the daily higher lows, anything above 86.5. Just looking for a higher low to continue this daily uptrend. That matters a lot because we're looking for the possible breakout here of the weekly time frame. Weekly MACD is getting a little bit better in terms of momentum, but still nowhere close to cross bullish. And overall, we are still kind of caught down here in monthly consolidation. Now we're in support, 93.5 down to 85 roughly, but still, right? No sustained breakout. I need a break and close above a 94.4 to really get me highly interested in not only this weekly trend change, but also finally starting to resume perhaps the monthly, because we never lost the monthly. It's just been this very slow and kind of miserable monthly consolidation. So longer term positions still attractive, but shorter term swing trades without that breakout, it's kind of tough to do. The best case for a breakout trade, you wait for the breakout, you take the breakout long, and then the stop goes below there, and you're targeting upside levels all the way up here, right? That would be decent. But as of right now, still just sideways consolidation. They're trying to get the daily going, but until you get the break of the weekly, you know, it might just do a whole bunch of this. Moving on to Ethereum right now. Ethereum is the exact same concept. They're trying to go for the daily uptrend continuation. We will see. Higher lows are all the way down there at 2,900. Weekly time frame, same concept, right? It's just a tightening range right now. Until you give me a break and close above 34.15, I can't say the weekly uptrend is good, and I can't also say that the monthly lows are set, because you always need to reverse these smaller time frames first. Sorry, guys, got something in my eye. But Ethereum right now is still the same concept, right? Very tough to build some swing trade longs from here without a key stop loss level, or or just some longer term positions if you believe in the thesis for Ethereum. That's everything for your overall market rundown. Hopefully you guys enjoyed that. Now let's dive into some of our big tech names. So moving first into Apple. Apple perfectly backtesting our zone. We were talking about this daily oversold condition being met yesterday, and today was the final straw of that daily consolidation, perhaps as we approach our final resting location for this downswing. Daily downtrend for the better part of the last 2 months or so. Weekly, additionally, right, we lost the weekly uptrend by losing the lows. Big consolidation, fast consolidation into our previous highs. We've been waiting for this level for a while, guys, right? Waiting for this little backtest here, 255 down about 245. This is the area that I'll be interested perhaps in building some swing trade longs. We will see how the price action evolves, but for now, selling put options down here, 250 and lower around the 200-day EMA, around the 12 EMA. That is the actionable step that I'll be taking on Apple right now, because we know that they have earnings at the end of the month, and we know they trade at a fairly rich valuation. So I don't want to just snipe these oversold locations, but when we come down into there, there's something to do. Apple doesn't get daily oversold that often, and usually when it does, it can be followed very closely by a nice little bounce. Now, it doesn't mean that we can't just roll the bounce over, but if you're selling puts and you do get a nice little bounce, it's enough of an opportunity to get out of the trade before they might hit you with this and then embark in a more slow recovery process for Apple into earnings. So that's how I'm playing it. I'm not going to predict that this is the absolute bottom and go higher. No, I'm just here to say we are now in an area that we can have some actionable steps. Not going with any call options just yet, guys. Still a little bit too early for that, in my opinion, but just something to pay attention to as we approach the actual landing zone down here. Moving into AMD, it's so funny to me that AMD and NVIDIA had beautiful conferences on Monday and have just done nothing but go down ever since. I guess that's just the way it works, right? Maybe a sell the news event type of thing. But AMD, let's be honest, right? They struggled to maintain this daily uptrend, and now we've officially lost it again. We are back into this very awkward range of price action, the culmination of which is these lows right under $200. The weekly still struggling to break out as well. We had it going, but we couldn't close the weekly candle above there. So once again, relegated back to these lows. If you do move a little bit lower, we're going exactly to where we've been saying we might head, which is this whole 190 to 175 area. Perfect backtest of prior support, resistance highs, support lows possibly, and the 12 EMA, right? For a just nice monthly casual retracement. The entire time it comes down here, decent for some share buy opportunities around 200 under a one peg, especially if you believe in the very massive revenue and EPS growth rates for the next few years. The thesis on AMD is as clear as it has ever been. The one thing that's not clear is the short-term price action, right? That's the nature of consolidation sometimes, but the longer-term thesis is not a question here. Massive EPS expansion and massive revenue expansion into the next few years. We will see what they deliver to us during their earnings presentation, the 3rd of February. Moving on to Amazon right now. Amazon, a very big winner because Amazon has many arms in many different businesses. Sometimes it's a consumer retail facing company and gets the love when consumer retail trades are up today. Sometimes it's an AI company. Sometimes it's an advertising company. Sometimes even it's a space company. We know space has been a very hot trade recently, and Amazon has their own Project Kuiper. Sometimes it's a robotics company, but sometimes it's a combination of everything, and everybody agrees. I will remind you that Amazon is the consensus trade for institutions this year as their favorite Mag 7 stock out of all of them. So we'll see what happens. Very nice day on Amazon, 2% higher, cracking through the big wall of resistance. That whole 240 to 230 range, very important zone. We will see what happens with Amazon, but daily uptrend, nice breakout. If you get the back test here, all that area will be acting as support, both for the daily time frame and also for this beautiful new weekly uptrend that they've just set as well. The monthly has always been clear as day, which is why I focused so much on it the last 3-4 months as we were accumulating down here. Well, at least I was accumulating some leaps, some shares, selling some put options to get some premium right. And now we might just be looking at the phase of expansion. But once again, we will see what happens. It's looking good right now, looking very good for the rest of 2026. Beautiful breakout. Moving on to Google right now. Google also brand new all-time highs today. Nice daily uptrend on Google as well. So really helping kind of lift, the SPY as much as they could, even though the rest of big tech wasn't there. But nice move on Google. Super hard to position up here though, because it's extended on everything, right? I mean, you got the divergence here, the bearish divergence. That's very clear. You got very overbought weekly RSI levels. It's just very tough to position on Google up here with anything, let's be honest, right? If you're swing trading from here, there is a tradable stop loss, below 310 as you go for further psychological expansion, such as 350. So not that bad in terms of risk to reward, but not my favorite trade overall because it's very extended. But one thing's for sure, the bulls control everything. The monthlies, the weeklies, the dailies. So the bias is still long, but it's a very greedy long trade up here because you're so extended across all the time frames and you are also quite extended in the valuation. This is the top end of Google's historical trading range, so keep that in mind. Moving on to Meta right now. Meta doing a whole bunch of nothing today. I mean, it was worse than where they closed, but still not doing a whole bunch of anything. Daily, bit of a downtrend here in a support. 645 down about 630 is the range. The weekly time frame also just shows some very awkward sideways consolidation. Meta has not done anything for the better part of the last, month and a half at this point in time. They gained a level quickly, and they didn't do anything, right? But Meta is still in a nice area of accumulation for some long-term shares. Low multiple, 21 forward PE, roughly, a 1.63 peg, decent free cash flow yield, decent price to sales. We'll see what happens when Meta delivers their earnings towards the end of the month and early February, but it is still a very nice trade to possibly be building into for 2026, as I do believe that Meta is pending the next monthly leg of upside. It's just that them and the rest of big tech have been somewhat soft. And another soft company, Microsoft. Sorry, okay, I'm going to stop with the puns today. Moving on a little bit further here. Rejection yesterday from resistance. We knew that. 500 down to about 490. Line in the sand stays put down here at about 470. Cannot lose those lows, or you embark into a new daily downtrend, a new leg of weekly downtrending consolidation, and just the extension of the monthly consolidation, which could see you come back into previous resistance highs, possibly support lows. We're at the 12 EMA, decent first entry location for some shares if we're looking to bid for the long term under a 30 forward price to earnings, which is cheap for Microsoft. Usually Microsoft trades in the mid to high 30s, a 1.66 peg, not bad. So here, 470 down to about 450, 440-ish, this little pocket between the 12 and 26, historically has been a good buying area. Whenever Microsoft tests the 12 and or deeper to the 26 in the context of bull markets, it's usually always been a very nice buying opportunity. And right now you have a very nice 15 or so % sell off from the top. And if we go all the way down there, it will be 20, usually a nice buying opportunity for Microsoft. So I will keep playing it as such, just accumulating a couple more shares. Moving on to Netflix right now. Netflix, sadly, not able to do much of anything. Daily downtrend, weekly downtrend, monthly downtrend, everything downtrending right now as we just oscillate here into daily oversold conditions, weekly oversold conditions. But we know, right, usually when Netflix comes down to the 26 EMA in the context of bull markets, but as I've shown you before, it does tend to be the bottoming out process, right? In or around, we're not saying this is absolute bottom. It can dip to the lower support level, mid 80s. But when you got the monthlies at the long-standing EMAs like this, you got the weeklies in such oversold conditions that we haven't really seen that much over the course of the past 4, 5, 6 years. And the daily also oversold. Well, you're probably closer to a bottom than the beginning of another 50% drawdown, right? So Netflix, it's not for everybody, but it is one of my favorite companies to add to at the moment from here all the way through the mid 80s. The bulls got to start everything from scratch. First comes the daily uptrend reset. Then comes the size of the weekly bounce into the weekly uptrend reset. And only then can you say, yeah, it's probably your monthly bottom and you might just be embarking into a new leg higher into the rest of 2026. But as of right now, no indication of that. In my opinion, that may only come from either a big earnings push or resolution of the darn Paramount deal, right? Moving on to NVIDIA right now, or the Warner Brothers deal that they're competing with Paramount with, right? NVIDIA down 2.15%. Awkward price action from the biggest company in the world, right? Had a beautiful presentation on Monday. We did cover the highlights on the channel and has done nothing but go down ever since. Kind of very unfortunate, but this area is a magnet, right? Big previous resistance, support, resistance again. And now I guess they're going to try it again. 185 down to about 178. Is the big zone on big days of consolidation like this. Just pay attention. You can find some nice opportunities to sell some put-ups options on NVIDIA in the lower 170s at the lower range of support, closer to the 200-day EMA and closer to the 12-monthly EMA, an area that NVIDIA makes quick work of usually when we come down close to it. So I enjoy playing short puts down there, but I also enjoy if we wanted to add to our swing trade longs perhaps, right? The valuation is still quite compelling here, in or around, 175, 180-ish, low 20s multiple, a 1 peg. So it is cheap for NVIDIA standards overall, and the price action has been pretty good, just very sideways accumulation right there, while clearly improving their fundamentals and reiterating their growth rate. So essentially what I'm saying is, you're probably not going to do this if their growth rates just keep being as high, but it's unfortunate, right? Not able to break out, and NVIDIA has just not been acting the same as it has many times throughout its recent price action. Moving on to Tesla right now. Tesla, 1% up day, reacting from the support range, 425 down to about 417. It's the lower bound of these guys, right? Big support, resistance, support once again. Not daily resold conditions or whatnot, but definitely a reaction zone. Sadly, the bulls have to start everything from scratch. We lost the daily uptrend, right? Clear loss of the daily uptrend. And so now, right, we'll be looking for the weekly lows to possibly be set in this very same area of price action. No big red flags on the chart, of course, right? Just sideways with a slight downward bias, monthly consolidation, which is completely normal. If you do drop one level for XYZ reason, you're coming probably down here to 400 to about 385. And this is probably the more clear level. Previous all-time high resistance, big support as we saw during early November as well. And the 12 EMA, this is the best area of confluence if you were looking to do anything on Tesla. But overall, the price action is not too bad, just kind of back into this very same trading range. Moving on to Palantir right now. Palantir down 2.65%. I think Palantir is like the only defense stock that was down today, especially after the 1 to 1.5, the movement of the budget in terms of defense contracting, right? President Trump saying yesterday they wanted to increase it for 2027 from 1 trillion to 1.5 trillion. And as a result, so many defense companies were on the highs today. Things like drones, like Ondas and Kratos, and things like AVAV for that same measure. And then you had other names such as the legacy LMTs of the world, the Raytheons, et cetera, et cetera. So all of them getting some big love, but the only defense contractor that didn't get much love today was Palantir. Once again, back in the gulag. So maybe Palantir is just getting too closely associated to this trade, the AI trade, the large cap tech trade, than it is to the defense trade. Very possible, right? That being said, we're kind of back into the range of price action. Line in the sand, 166. You don't want to lose this, guys. You lose that, it's a daily downtrend, and unfortunately, you're going for more weekly consolidation. The bulls need to get a stop to this quickly. If not, you will very quickly just continue the monthly consolidation range, which could bring you back down into the 150. I'm not saying it's going to go down there. I'm just saying pay attention to your levels, right? If you break this, it becomes more and more likely that you're going for a full retracement to the same effect that we saw very late November overall, and a retest maybe of the 200-day moving average. It's not looking too bad. We haven't lost the area. But if you lose this big area and you lose your higher lows, well, then there's not much stopping them from retesting the mid 155 area, is there? So pay attention to that on Palantir. Moving on to our few last ones here. SOFI up 2.67% today. Not a bad day for SOFI at all, but still the price action is somewhat muted, right? Until we really clear this 30 to 28 area, we can't really say who is clearly in control. Sure, you can argue there's a daily uptrend here, and I could possibly agree, but this is clearly the area that the bulls have struggled with many times in the past 3-4 months. The weekly shows that even better, just a very awkward accumulation range between this area and below support of 25 to 22. And the monthly time frame just shows extended monthly consolidation after a 3-4x sideways consolidation with a slight bearish tilt. Now, the best way of playing this is either accumulating some positions if you're bullish on the company and you want to ride this one higher, you think they're going to have a good 2026. It's giving you a nice accumulation range here down through this lower support area, 27 to about 25, good valuation, low peg ratio, and decent price to sales. We'll see what happens with SOFI overall. Not looking terrible. My favorite way of playing this one is either just accumulate longs slowly but surely, as you've been presented the opportunity to do so in the past 3-4 months, and even selling some put options down here, just selling credits, farming credits in the market. Short puts down here, 25 or under. I've been doing that for a very long time at this point as well. Moving on to Uber right now. Uber, another very good day, 1.62% to the upside, challenging resistance, 91 down about 87, let's call it. It's a big area, guys. It was previous resistance, support for a while, resistance again, and now possibly resistance again. So the weekly is still in a downtrend. Nice bounce play, though, by the bulls. Nice. So now if they retrace, you got a lot of space, anything above 79. Looking for the higher low, maybe the two-step process. If they run out of momentum and can't just crack this right away, you may have to do it in 2 steps. So watch out for that. If you do come a little bit lower, I'll be once again playing some short puts below this area, or maybe even looking for further shares, perhaps, if that was interesting to you. $80 range, low 20s multiple, 1.43 peg, and a 5.25 free cash flow yield. Moving on to TSM, lastly but not least, TSM down 0.21%. They had a good start to the morning, but sadly, they got dragged down, right? Huge open at 930, huge. And they gave it all back almost instantaneously and then just slid all throughout the day, just being too closely associated with the rest of big tech out there. But beautiful breakout, right? Who's complaining? Daily uptrend, all-time highs, in a consolidation phase right now. 310 down to 303 is your support range overall. The weekly still looking very firm right now. Weekly uptrend looking for the same thing, just a possible back test of the prior resistance range, which is now support, and the curling up of the good old 12 EMA. Not looking too bad for TSM up here. Would I be buying TSM up here for the long-term portfolio? Well, no, it's not that expensive at a 425 PE, a 1.34 peg, and a mid-sevens price to sales. Not a bad free cash flow yield, great revenue EPS growth, great pricing power, solid company, fantastic margins. We cover it every single quarter. It is one of my favorite semiconductor companies out there, of course. I'm just not adding any more up here. I'm personally full. You can make a case for a bit of a nibble if you're looking to hold it for the next 5+ years type of thing, right? But starting a brand new full size position up here, I just don't think is the best in terms of overall risk to reward, but you guys do you. That's everything for me in terms of today's big market rundown. Now let's spend about 10 minutes going through the biggest gainers and losers of the day. And I guess we're going to start off on the loser side, and then we'll play our infamous game. Is it too late for Ondas, for Kratos, for AVAV? Is it too late for so many of these names that have printed the highs since the start of the year? I mean, look at some of these gains, right? Since the beginning of January. Right? From these lows, AVAV to the highs of today, that's 53%. Ondas, kind of the same concept, right? Let's take December 30th. This low right there, 76%. Kratos, same concept, right? This is like a 45% move. So is it too late? Well, the quick answer is yes, but I'll explain why. But first we got to do the biggest losers of the day. So let's do that first. Okay, so talking about these cybersecurity names, you might remember that I brought these ones up yesterday. They've been in extended monthly consolidation, talking about Cloudflare, talking about Rubrik, talking about Datadog, extended monthly consolidation, talking about CrowdStrike, talking about Palo Alto Networks. Now, my favorite ones out of the entire bunch is SentinelOne, thereafter Rubrik, and then CrowdStrike and Palo Alto Networks. Those are just my personal favorites. But if you don't have a personal favorite and you just want to play the industry, because I think the industry is going to do very well, total addressable market is huge into the next 3 years, you can play an ETF like CIBR. There's many more, but this is pretty much the biggest one, right? With decent allocation to all those companies. We can play a ETF as well, and there's no harm in doing so either if you just don't want to take company-specific risk. We'll cover a couple of these as we move into the earnings season. I didn't cover many of them last earnings season, but still in monthly consolidation. And until we can get some confirmed daily and weekly trend changes, the consolidation on these names will simply continue. And I'm forgetting Zscaler is in the exact same situation as well. This one's been getting a lot of attention recently, but you got to change the trend first. And so far, those are just big old downtrends. Moving on a little bit further down the risk, we've got to talk about some of the let's just call them second order plays for data centers, right? Talking about VRT, which does cooling and various other elements, right? VRT down considerably. Pay attention, 12 EMA retest, right? Down here, 147, 140. This is an area that wouldn't be too bad for VRT as of right now, though. Still just an extended consolidation. We could talk about a couple more. I mean, even a company like ANET, super solid company, very strong margins, very strong revenue and EPS growth. We do a good job of covering this one as often as we can. Down here, guys, 12 EMA, it's coming shortly, right? ANET, every time it's come down there in the past few years since they've been extremely popular and essential to the data center landscape, essentially, right? Well, that is possibly an area. You came into big divergence, and now it is just correcting in the direction that it should. After a divergence like that, high quality companies, so some of these high quality companies are coming into very attractive levels if you do want to play them overall. And I guess the same can be said about other companies that had tremendous rallies, such as Celestica, right? Celestica, got a lot of questions about that one. Pay attention, mid 200s if this weakness does continue. I'm not saying it's necessarily going down there. They seem to be trying to holding this. I'm just saying if you can find these companies at their 12 EMA retests, it presents better opportunities, right? Better opportunities for backtests, and you know that you're getting a better deal overall. Same can be said about ALAB. ALAB, pay attention to it down here, 12 EMA retest again, right? For a lot of these companies that would be down from their highs, huge, right? That would be 46%. Celestica down here, that would be 37%. VRT down from the highs, that would be 30%, right? So we can't say that they're not coming when they've showed us that many times in the past, they do that, right? So I'm of the opinion that we have to be patient for our levels. And then when the levels come, then we can participate. If they just don't give us the level entries and just run away, no problem at all. There's so many stocks in the market. There's so many components to the data center trades. Some will give you the infamous 12 EMA back tests. You just got to know what you're looking for and just got to kind of play them accordingly when they come close. And that's usually when you get the best risk to reward, right? We'll talk about those names in a little bit, but that's just how I'm kind of seeing the market right now, which is why some names like SanDisk, you can make an argument that SanDisk and Micron might never come back and test their 12. Maybe not in the short term, but, memory, it's always the question of, I'll just cover this right now because then after this, we're going to play, is it too late on a lot of these companies, guys? And we're going to talk about the concept of conviction, right? The concept of conviction is very simple, right? Like, how can you get behind buying Micron up here? Is it because everybody's talking about it, because people know the prices of memory are through the roof? There's not enough supply for all the demand, et cetera, et cetera. Everybody knows the thesis, right? But you can have a very good fundamental thesis, but still want a great technical entry and feel like you're getting a good deal. The concept of conviction comes into here. Conviction is really a question of two different parts, guys. You can only truly have conviction in a company for two different reasons, or a combination of both, right? Number one, because you know the company very well. It's not just something that you see plastered all across social media and you just blindly follow without doing your research. No, conviction comes from deep knowledge about a company or an industry. And the second part of conviction comes from having a great cost basis, right? When you buy things early. I'm pretty sure that people who bought Micron down here between 80 and 120, like we did in the Discord, if Micron has a 30% pullback, right? Well, we probably don't care because we have a fantastic cost basis and we understand the business, right? But if you're buying Micron up here, or if you're buying SanDisk up here, or WDC up here, or a company like Seagate up here, right? Well, you may have knowledge about the business and what's going on, but do you have a good enough cost basis? If this stock were to somehow, because anything's possible, drop 30% for a healthy retracement, just like the data center plays were super hot at one point, everybody wanted them, and then everybody just ditched them and dumped them as if they were generating no revenue anymore, right? Well, if those companies have such a steep retracement, it's kind of like silver as well, right? Anything that's run super hot. If you have a very bad cost basis, right? The fundamentals can be cheap on these companies, and I do agree. But if your cost basis is not a very good one, objectively speaking, in relation to other people who were early, you can have all the conviction in the world. It'll still make you very nervous. And you'll start asking yourself, oh, did I buy the top? Should I even be in this? Did I chase? Or more importantly, if it comes down there, are you going to DCA, right? Those are problems that people who are early, they just don't have. So when I see trades run away super hard like this, I may have very big knowledge about what's happening for the sector. I might have done my due diligence. But if I can't guarantee myself that I know that I'm getting a very good cost basis in relation to the risk to reward, then I will never truly have conviction. It'll always be something that I'll be thinking twice about, right? So keep that in mind when you're thinking about chasing so many of these plays for XYZ reasons. If you see them plastered all across social media, etc., the thesis may very well make sense, yes, but you are not early and you will never feel early, especially after such monstrous rallies such as the ones like these have had, right? It's much easier getting into something early, and then if something rallies a ton and you're still in, it's much easier to absorb some of these natural, healthy drawdowns, right? Somebody who has a cost basis down here, well, when it moves down, he can still have high conviction. Somebody who bought all the way up here, they may just get shaken out, even though they don't know just as much about the industry, just because they know that they chased and they didn't get the most optimal price. Even if the thesis is that it's going to recover later, you always got to figure out, right? What is your risk to reward, right? How much meat is there left on that entire trade? So please keep all that in mind when you're analyzing either these trades that pulled back today or other trades, such as the ones we're about to talk about. Now, we can go through this entire list, but the premise is the exact same, right? Guys, just be patient and wait for things that pull back, things that you have high conviction in, but that you've been patiently waiting back to pull back to big monthly levels, like Broadcom down there, or like CrowdStrike to its own respective EMAs, or whatever you're trying to do, right? Or even Spotify, right? Spotify was much better buy here and down there than it ever was all the way up there, right? So just keep that in mind. Same thing for ASML, right? I bought a huge boatload of ASML down here. I'm not buying it anymore up here. You know what I mean? But I can absorb this drawdown and I won't care. Why? Well, because I've been in ASML for years and years and years, but my cost base is super low. I don't care. I can absorb these swings. Somebody who just bought the recent tops probably can't. Does that all make sense? Hopefully that makes sense, guys. Moving on a little bit further, we're going to play the game. Is it late? Is it late for Ondas? Well, I mean, it has a whole bunch of retail momentum, but this is the same thing. We were talking about this stock here on the channel, right? To pay attention to it, possibly position. Now you're talking about a company that is trading for $5.3 billion. And even if I go out all the way to 2028 sales, that's $355 million. They're literally trading 15 plus 2028 price to sales, let alone 2026. You don't even want to know that number, right? But that doesn't stop the fact that it can keep pushing higher. And that's what I've said literally every single day for the past 4 or 5 days. It can keep pushing higher. That's the nature of momentum. But when the fundamentals don't make sense anymore, it comes back to the same thing that I just said previously, right? How do you have conviction? Conviction starts by having, number one, a great understanding of the business and the industry and why it's running. But number two, it comes as having a nice cost basis. If I have a cost basis here and it pulls back like this, I'm probably fine, right? If I buy all the way up here with FOMO and it pulls back 30, 40%, well, then it's very funny. Then people do all the research because they want to understand why they're down, because they got dragged into a trade late. And now they're wondering why, right? Moving on to Katos. Katos, same thing. When we were talking about it on the channel, it was down here. Big surprise. Why were we talking about it down there? Because it literally completed almost a full retracement. And at that point, the valuation made a decent amount of sense. Same thing with cost base. If you were early on Kratos down here, or even down here, you can absorb, right? It's never good buying this when the stock is up 50% in like 2 hours, right? But somebody who has a cost basis down here, they can more easily absorb this. Then if it's green again tomorrow and then pulls back on you, well, then you're not going to feel too good, are you, right? So keep that in mind. Kratos, solid company, $17 billion company. I'm not saying that it's super expensive right now, but you know that if you're buying it up here, you're largely chasing because of the news that came out just the other day. They're currently trading at just over 10, roughly about 12 times 2026 sales. So keep that in mind, right? To where previously it was almost a no-brainer buy. Now it's kind of on the fence, right? So when you know that it's not the best possible position. And the same things can be said about names like AVAV, which has ran a ton. Where was the best time to buy this one? I don't know. Maybe perhaps pullbacks in the 12 EMA. Just maybe, right? Maybe not all the way up here. If it's gone, it's gone. There's many other companies that you could possibly seek to position in, but this wouldn't be my first choice at these current levels right now. So keep that in mind for everything else. You got some of the home builder names, which are coming up, BLDR. Not bad down here, but if I'm going to play the home builders or anything associated with them, I'll probably play just XHB, the ETF, not individual names, but shout out to them as well. And several other mini consumer names are also coming back. We commented on that previously, but Elf Beauty is also one that I hold in my long-term portfolio in around the $80 range, right? The valuation is quite cheap for this one. So if we are betting on several aspects of the consumer to recover, well, I will still be kind of targeting these cheaply valued companies overall with great sales numbers that just got pulled back for things outside of their control, such as tariffs, right? This is not a big recovery story like Nike that had a massive execution problem. No, this is just a company that got brought down because of the overall state of the market, trading at a cheap valuation, still with very strong revenue EPS growth numbers, still with a very solid customer base overall, right? So keep all of that in mind. We've covered all the other ones. I hope you guys don't want me to redo IREN and NBIS. You guys know where I stand on these ones, right? Still in accumulation range. Everybody wanted them here. Nobody wanted them here. Everybody wants other things that keep running on the highs, but I'm still in an accumulation phase for these. Here down through the 12 EMA, decent proposition. IREN as well, if that's your thing. CIFR, if that's your thing as well. No problem at all. Just make sure that you are getting some sort of a better price, either by selling puts down there or just slowly accumulating shares as we move through these phases of consolidation. And you guys know it's the execution layer right now, right? The previously was the big funding layer. Now you got the execution and the actual build layer of the data centers, and then you'll actually see the revenue and profit phase. Now we're in phase 2. The execution phase, which is why nobody's interesting, because big tech hasn't been throwing around hundreds of billions of dollars in terms of headlines over the past month and a half, which is why these companies have been coming down a little bit. So that's kind of everything for today, guys. I think we covered most of the themes, most of the narratives, and even if we didn't cover individual names, well, now you guys maybe know how to analyze certain things when they run heavily to the upside or to the downside and understand why you are looking at them and what you can possibly derive in terms of a trading plan. So that's everything for me today, guys. Hopefully you enjoyed. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new. Would love to have you back. We do these every Monday to Friday after the close. Not tomorrow night, though. Tomorrow night, I'll be away, but I'll film the Friday recap video on Saturday for you guys. And last but not least, if you have any questions, feel free to leave them down below in the comments section. I know I haven't answered questions recently, been very busy, but tonight I'll make it a mission of answering all previous comments from this week. And that's it for me, guys. Take care. Have a good day in the markets tomorrow. Just watch those non-farm payrolls numbers and pay attention to your VIX if you are an option seller. So take care, guys. That's it for me. See you next time. Peace.